So you want to buy a train. Or at least you want to know what happens when someone wires the money for a train. Well, a single freight rail engine costs around $3 million. That's just the engine, no car, no track, no employees. And that's one engine, but the typical railroad company, say BNSF in America, has over 8,000 of them. That's around $24 billion in engines alone. So what about the cars? A new tank car, the kind used for chemicals or crude oil, runs about $130,000 to $180,000 each. A covered hopper for grain, similar. A double-stack intermodal car for shipping containers, north of $200,000. A full coal train typically runs 130 to 150 cars. Do that math, you're looking at $20 to $25 million for the cars alone. Then there's the track. Unlike trucking companies, which use publicly maintained highways for free, or close to it, America's major freight railroads own and maintain their own infrastructure. We're talking about 140,000 miles of privately owned track. In 2020 alone, the Class 1 railroads spent nearly $24 billion in capital expenditure just maintaining and upgrading that network. That's 19 cents out of every dollar of revenue going straight back into the ground. Now you begin to understand why freight rail is one of the most capital-intensive businesses on Earth. The entry cost isn't a barrier, it's a massive wall. So who actually gets over that wall? The answer isn't who you think. Yes, the big Class 1 railroads. Union Pacific, BNSF, CSX, Norfolk, Southern, CN, CP own a large portion of their own fleets. They have to. Running a network that covers half a continent requires assets you control directly. But here's where it gets interesting. Over 60% of North American freight cars are privately owned or leased, not by the railroads themselves, but by a shadow industry of financial companies, leasing firms, and industrial corporations that most people have never heard of. The biggest player in this world is a company called GAT. Based in Chicago, GATX owns over 200,000 railcars, tank cars, covered hoppers, boxcars, and leases them out to railroads and shippers. In 2024 alone, GATX's North American rail fleet was running at 99.1% utilization and generating hundreds of millions in annual profit. Not by moving freight, by owning the vessel that moves the freight and collecting rent on it. This is the key insight. GATX is not a railroad. They don't employ conductors. They don't dispatch trains. They don't deal with derailments or labor unions or freight contracts. They are, at their core, a landlord. They buy assets, lease them out at attractive rates, and wait for the checks to come in. And they're not alone. Wells Fargo, yes, the bank, had a railcar leasing portfolio worth $4.4 billion before selling it to GATX and Brookfield Infrastructure Partners in early 2026. Trinity Industries, Union Tank Car, CIT Group. These are financial institutions playing in a world most people associate with grease and steel. Now let's talk about how they actually make money, because it's more nuanced and more brilliant than it first appears. There are 3 ways to profit from owning a train asset: leases, appreciation, and scrapping. And the way they stack together is genuinely elegant. First, the lease. Locomotive lease rates typically range from $300 to $1,000 per day, depending on age, horsepower, and market conditions. A single modern road locomotive leased out for a year at $700 a day generates over $250,000 in annual rent. A fleet of 100 units, $25 million a year. The beauty of the model is that lease contracts are typically multi-year, 3, 5, even 10 years, with the railroad locked in. Once the asset is deployed, it just earns. Rail cars work similarly. A tank car leased at $1,000 a month, renewed year after year, over a 30 to 40-year lifespan, generates multiples of its original purchase price and total rent. GATX's own data shows renewal lease rates jumped over 26% in a single quarter in late 2024, meaning when old contracts expired and got renewed, they reset to dramatically higher market rates. Inflation and supply constraints worked entirely in the owner's favor. Second, the asset itself often holds or gains value. New railcar production is slow. The manufacturing base, dominated by Trinity and a handful of other builders, can't surge output quickly. When demand rises and supply can't keep up, the secondary market price for used railcars climbs. A car bought for $130,000 several years ago might sell for $150,000 or more today, purely because the cost to build a replacement is now higher. GATX generated over $130 million in asset remarketing income in 2024, just from selling cars at the right moment. Third, at end of life, there's still money left. Railcars live hard lives. 30 to 40 years of constant loading, unloading, weather, and impact. When they finally retire, they don't disappear. They go to the scrapper, and scrap steel has real value. Lessors build the scrap recovery into their long-term financial models, treating it as a guaranteed terminal cash flow. Add it all together: rent income for 30 to 40 years, possible appreciation, then a scrapping gain at the end. The asset earns on the way in, earns throughout its life, and earns on the way out. This is why private equity firms, pension funds, and major banks got into this business. It's not glamorous, it's not fast, but it's remarkably durable. Freight still needs to move in a recession, in a pandemic, in a trade war. The trains run regardless. But here's what the glossy investor presentations don't put on slide 1. By the way, if you are enjoying this video, make sure to subscribe because we have a lot more coming. The risk is real, and it can be catastrophic. The first hidden danger is regulation. The EPA's Tier 4 locomotive emission standards, which took effect in 2015, essentially forced a massive repricing of older locomotive values overnight. Owners of pre-Tier 4 engines suddenly faced a choice: pay for expensive retrofits, restrict where the locomotives could operate, or accept sharply discounted lease rates. One locomotive manufacturer's Tier 4 product was so troubled with reliability problems that fewer than 200 units sold. Regulatory shifts can devastate your asset's value with no warning and no compensation. Then there's the storage problem. When the economy slows and freight volumes drop, lessors and railroads suddenly have cars they don't need. Parking a surplus railcar isn't free. Storage fees can run $100 to $450 per car per month on private sidings. A lessor with 5,000 unneeded cars is paying $2 million a month just to park them. And you can't just abandon them. Lease contracts are legally binding, enforcement favors the lessor, and penalties for early exit are steep. There's also the maintenance trap. A full engine overhaul, stripping down and rebuilding a 6-axle locomotive, can cost 10 to 15% of the locomotive's original value. On a $3 million engine, that's $300,000 to $450,000 every major maintenance cycle. Miss one, and you're not just looking at a repair bill, you're looking at a catastrophic mechanical failure, regulatory violations, and potential liability if that locomotive is involved in an incident. And finally, concentration risk. If you lease 80% of your tank car fleet to one chemical company, and that company goes bankrupt, or shifts to pipeline, or loses its environmental permits, your income stream evaporates simultaneously across hundreds of assets. The very long-term nature of the contracts that make this business attractive can lock you into a deteriorating counterparty for years before you can exit. This is not passive income. This is a high-stakes, capital-intensive, heavily regulated business where fortunes are made slowly and lost quickly. Here's the conclusion that most people miss when they think about trains. The railroads, the ones whose names are famous, whose locomotives are photographed by enthusiasts, are in the transportation business. It is a tough, low-margin game of managing infrastructure, labor, fuel, and regulation at enormous scale. But the people who own the equipment those railroads depend on, they are in the finance business. They've separated the asset from the operation, collected the steady rent, and let someone else deal with the headaches of actually running a railroad. It's the same model that drives commercial aviation, maritime shipping, and commercial real estate. The operator takes the operational risk. The owner takes the financial return. Warren Buffett understood this deeply enough to buy the entire Burlington Northern Santa Fe Railroad through Berkshire Hathaway in 2009, paying $44 billion for an asset that owns its own track, its own fleet, and generates predictable cash flows that compound quietly for decades. The locomotive that just rolled through your town? It's carrying more than freight. It's carrying someone's retirement.